Good morning, and thank you for joining us for the May 21st, 2024 meeting of the Chicago Teachers Pension Fund Investment Committee meeting. For the record, I am Jacqueline Price Ward, Vice President of the CTPF Board of Trustees and Investment Committee Chair. This meeting is being held in person at our offices at 425 South Financial Place. The Investment Committee is a committee of the whole and includes all CTPF trustees. A quorum for the committee is 7 trustees on site. And I see we have 8. You're good. Please note the following. Access instructions for remote attendance and instructions for in-person attendance have been posted on the fund's website. All participants, please wait to be recognized by the chair before speaking, and please limit discussion from each trustee to 3 minutes. Please note that for our staff and trustees to focus on the business of the meeting, we will not be responding to messages from participants using the Zoom chat feature. Please forward questions to membershipservices@ctpf.org. Again, membershipservices@ctpf.org. We will now move to public participation. Do we have any members of the public who wish to be heard? Okay.
Yes, Ms. Tina Padilla on
Okay.
Zoom.
All right. Good morning, Tina.
Good morning.
How are you today?
I'm good. How are you?
I'm great.
Thank you. Well, I'm here to ask a very important question. I did ask at the May webinar about the due diligence. I was a trustee and investment chair for many years. And my understanding of our statute that governs our due diligence is I was told, and I did my own investigation, so I know this, that our statute, and I guess it's interpretation, but our statute requires that the trustees do due diligence on an annual basis for their managers. And when I say due diligence, I know that the staff who is paid, they have to do their job. And part of their job is to do the due diligence, because due diligence is an investigation, an audit, or review of performances to confirm facts or details for a matter under consideration. In the financial world, the due diligence requires an examination of financial records before entering into a proposed transaction with another party. The due diligence is a systematic way to analyze and mitigate risk from our business or our investment decisions. So I am harping on due diligence today. The trustees, and I'm talking about trustees, I know we have paid staff that does due diligence, but for the members and the public to understand and to have a way to follow, transparency is one of our claims to fame, right? So if we could have some kind of standardization, I call it a schedule, and we schedule when the trustees will be doing their due diligence on our managers. That was because my question was, again, where can I find the due diligence schedule? And the reply was the investment team conducts due diligence with each manager on an ongoing basis. Terrific. And is not bound by specific annual calendars. That statement right there made me very nervous. And that's why we need the communications committee back. So the members of the public We only can, the system was made, our board was made up of 12 trustees where the members could go and access our leaders, our leaders that we put on the board to help us. So please, again, I'm coming back to the investment committee meeting because we need the communications committee so we could communicate and maybe perhaps put something up that our members and public could follow our due diligence. Thank you.
Thank you. Thank you. Next, we have any more?
Yes, Ms. Dawn McGrath on Zoom.
Good morning.
Oh, there's public participant. Okay, thank you.
I don't. Ms. Perez? McGrath? I thought she said Perez. It's McGrath.
Hello, can you hear me? Sorry.
Yes, we can hear you.
You can hear? Okay, great. Sorry, I just getting connected here. Oh, I was just wondering, are we supposed to have 11? We just have 11 members out of the 12 board members. Is that correct?
Yes, so you can stay here tonight. We don't do questions during public participation. But
Okay, yeah.
But everybody doesn't come.
So we have to email that to find out why we don't have everybody here.
We have a quorum present.
There's a form.
I'll just say you'll respond in writing to it.
Okay.
I see. In writing.
Executive director will inform you in writing why there are, if you're questioning the number of members on the board that are seated on the board.
Yeah, that's what I'm questioning. I don't know why everyone isn't here. That's my question. So I have to have this in writing. You can't get an answer right now.
You said yes.
Mhm.
Okay, I understand. I'll get it in writing. Thank you.
All right, thank you for coming. That concludes our public participation. Yes.
Yeah, I do, I'm sorry, yes, I do have a question. So for the investment team, do we have a schedule, or can we get a schedule as far as due diligence and?
We can have a schedule.
Okay, no, do we have one now?
No, I'm not aware of a schedule now.
If Fernando, or I don't know if that would be you.
We can provide a historical schedule, the due diligence that has been conducted so far, but I can tell you that on the traditional side of the portfolio, it happens every quarter. And on the alternative side, at least once a year, annual general meetings. In fact, there's one that's taking place today. Summer attended because we were on the LPAC. But if you'd like a historical listing of meetings that have taken place, we can put that together.
Well, historical would, if I may, historical would be great, but future meetings at one time and, things I guess have changed, but we always knew what the schedule was. We did used to have a schedule way before you came. Thank you.
Are there any more questions or public participation? Okay, thank you. Oh, excuse me. Now we will please call the roll.
Trustee Beza. Trustee Barajas.
Present.
Trustee Blackwell.
Present.
Trustee Nelson.
Present.
Trustee Ochoa.
Present.
Trustee Price Ward.
Present.
Trustee Riley. Trustee Rodriguez.
Present.
Trustee Benson,
Present.
trustee Washington,
Present.
trustee Woods. Thank you.
Thank you, Serena. We have 8 trustees on site and have a quorum as required by the Open Meetings Act. We will vote to approve trustee remote attendance and full participation. Do we have any remote attending trustees? Okay. Is she here? Okay. Okay, all right. So we have no remote trustee in attendance. Okay. So we will go on with our agenda. Approval number 4, approval of the minutes. Can I have a motion to approve? Trustee Washington and trustee Vincent. Trustee Washington made the motion, trustee Vincent second. Okay,
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
yes,
trustee Rodriguez,
No.
trustee Benson,
Yes.
trustee Washington.
Yes.
Thank you. 7 ayes, 1 nay.
thank you. So we will now move to the international equity structure recommendations, and I will turn the meeting over to Fernando Vincent, our CIO, and our investment team.
Good morning.
Good morning.
So our objective today is to conclude the international equity search that started with an asset allocation study a year ago. And that was followed by an asset class structure review. And then earlier this year, we heard from several sets of managers because it was an all-encompassing search that included core, value, and growth. We were deliberate about our pacing to give the market time to recover, and it's done just that. But that's why it's taken us a little bit of time. And you heard from, again, 3 sets of managers. We then took the results of your finalist candidate selections to develop options of how our international equity portfolio would look like going forward. Just to note, Callan will talk about 2 options, but then there are sub-options within each one that considers the expansion of value managers from 2 to 3 managers. So at that, I'll turn it over to Callan to discuss their work, and then we'll wrap it up with discussions and recommendations.
Good morning, everyone. But before we get started, as always, I always like to begin by thanking you for the opportunity to be here. Always an honor and very happy to be with you. So why are we here today? Today, we're here to talk about the international equity structure, which defines how you implement your asset allocation, in this case, with a focus on your international equity portfolio. The objective of this exercise, or the objectives, are listed on page 2 of this material, the International Equity Structure Review. And as you can see in the middle of the page, there are several objectives we thought about as we went through this exercise. One is to reduce what we call misfit risk, and forget about that term. We'll talk about that. Okay, so basically reduce risk. Also take this opportunity to continue to enhance the exposure to diverse managers in the program. And as we've stated before, this pension program sets an example, in my view, in the United States in terms of providing opportunity to diverse and emerging managers. A significant component of the fund is managed by diverse managers, and you really set the tone for the country. And you should be very proud about your accomplishments in that process. And the third objective is to make sure that the fees remain competitive, essentially, as we go through this exercise. Now, before we dive in, let's talk about, you're going to hear some terms here that may be confusing, and I want to make sure we address that up front so that the rest of this presentation makes sense. You're going to hear about tracking error, and you're going to hear about misfit risk. They both mean the same thing. They both mean risk relative to the index. That's it. So if you have a portfolio, right, that is passively managed to a certain index, then in theory and in practice, in many cases, the risk, the relative risk, right, is basically de minimis because you're not taking any bets relative to the benchmark to add value, right? So if you have at the portfolio level, if you have a certain position that you have conviction in, you say, well, let me overweight Apple because I think Apple is going to do better than the rest of these stocks in this portfolio. That may translate into excess returns, but you're doing that at the expense of risk, right? You're different now than the benchmark, and that creates relative risk, is tracking error. Now, when you look at the composite level, at your total international equity portfolio, the way that your managers are stacked up and the strategies represented in your portfolio can be different than the overall benchmark. In this case, your target benchmark is the ACWI ex-US IMI index, which provides broad exposure to the international markets, including large cap, small cap. It's the broadest exposure possible. Developed markets, emerging markets. If you stack up different managers with dedicated exposures and those benchmarks are different than the overall target benchmark, that's tracking error. That results in tracking error. So the objective is to reduce that noise, to have a set of managers that have more focused strategies in terms of managing to that broader benchmark so that we can reduce relative risk. Is that clear to everybody? So when you hear misfit risk, tracking error, we're trying to reduce that. That's what we're trying to do, okay? Now, if we move on, I basically covered page 3 already. So why don't we move on to, and page 4 for that matter, but here are essentially the definitions of selection risk and misfit risk, both translating into tracking errors. I'm not going to spend time on that. Page 5 articulates what we're trying to do. So we went through an asset liability study and a new asset allocation was selected last year, bringing the asset allocation within international equities down to 20.5%. That's the new target. The current international equity exposure represents about $3.3 billion as of March 31st. The new target represents $2.6 billion. So we have to bring the allocation down. And this, I think, represents a good opportunity to simplify the portfolio, which is part of this exercise, okay? And as you can see, the total market value of the fund is $12.5 billion at the end of the first quarter. Page 6 lists your current managers in the international equity composite. You can see them listed on the table at the top of the page on the left. Now, before we go through the proposed actions on the right, why don't we take a look at the statistics at the bottom of the page? And I promise you, I'm not going to walk you through each of these numbers. There are 2 numbers that I think are important. The first number is in the middle of the page where it says style versus benchmark. This represents the position of the portfolio relative to the broad ACWI ex-US IMI target index for the international equity composite. And you see some percentage differentials there. So within value, you see a negative 4.7%. Within core, you see a negative 1.4%. And within growth, you see a positive 6.1%. What this means is that the portfolio today has an overweight to growth. So it has a growth tilt relative to your target benchmark. Now, that's worked out great for the fund because growth has been in favor over the last number of years, 10 years or more. But going forward, these things ebb and flow over time. That will correct. So what we're trying to do is to eliminate that excess growth position, neutralize that exposure through the structure that we're doing now, okay? The second number I want you to pay attention to is at the bottom, it says, where it says regions versus benchmark, you see developed and emerging markets. Right now you have a slight overweight exposure to developed markets. We're trying to correct for that as well. And when Tony reviews the alternative structures we've evaluated on your behalf, you'll see that these numbers basically come down to near zero. All right, so that is a proof statement, right? That the characteristics represented by the managers that that have been evaluated in this exercise help reduce this relative risk or misfit risk or tracking error. They're all the same thing. Okay, so with that, why don't we review the proposed actions at the top of the page? So in order to get to that destination portfolio, we need to make some changes to the current portfolio. And that will include either eliminating some positions or repurposing some of the assets. And the proposed actions are represented here. So for the first manager, you can either consider moving that to an ACWI ex-US mandate, or there may be a position which is maybe prudent as well to pursue a different opportunity within the structure. The second manager listed here is we're proposing that manager be eliminated because we have a better opportunity set with the managers that have been identified in this exercise. The third manager, you can see that we're suggesting to move that to an ACWI ex-US mandate, again, to reduce misfit risk and move away from IFA dedicated managers. And then you can see the proposed items for the rest of the managers here. I'm not going to go through each line item, but you can see what the proposal is in terms of the changes that are necessary in order to get to the new destination portfolio. So with that, I'll turn it over to Tony to walk us through the balance of the analysis. Any questions so far before we do that? No? Okay, Tony? Oh, please, go ahead. So what that means is we're moving away from a dedicated exposure in a certain area to an ACWI ex-US mandate, which is a broader mandate consistent with the benchmark, the strategic benchmark that the overall composite is designed to follow or to outperform in this case. I'm sorry? Sure. So right now you have managers that have certain dedicated exposures that are different than your target benchmark. We're trying to eliminate those positions or repurpose certain positions so that we can move closer to your target benchmark. Because the more different you are from the target benchmark, the more risk is inherent in the portfolio via tracking error risk or relative risk.
Hey, Angel, I would just, so for Aerial and Strategic Global Advantage, they are advisors, they are both developed markets only. So we're recommending moving to a developed market plus emerging market strategy. So instead of just focusing developed markets, they would also include emerging markets.
Thanks.
That one's a little hard.
Sure. Sure. So where it says eliminate, we're suggesting terminating that manager. So in this case, the Morgan Stanley account should be terminated and those assets will be repurposed. If you move down the table, Earnest Partners, we're suggesting we combine that with an emerging markets position. So again, a broader position within that ACWI ex-US mandate and moving away from developed plus emerging, right? So right now you have a developed position with Earnest and a dedicated emerging markets equity position with Earnest. We're trying to move away from that into one combined position for that broader exposure, okay? Going down the table, Lazard, we are proposing that you terminate that relationship, and those assets will be repurposed. Okay,
So is this in all areas, when you have eliminate, it's saying that that's a total elimination of every area that they're in?
correct. That is correct.
And that's reason.
In some cases, it's due to performance concerns. In other cases, the strategy employed by that manager no longer fits the structure that we're trying to achieve. And then the balance of the table essentially suggests that we.
Thanks, okay.
that
You know, I'm sorry, I didn't have the mic on. I
Oh, that's
just
right,
forget
okay.
about this mic.
No worries.
Thank you.
I could hear you anyways.
No, but you can hear me, but the others couldn't hear me because I was requesting more of a definition as to what we're looking at.
Sure.
And so you were telling me, but I'm not sure that others were understanding what we're talking about.
Sure, sure.
So I thank you so much. Chair. Okay.
Sounds good. So
Okay,
hopefully,
so can you just briefly, since now we're on mic,
yes,
so that those who are tuning in, as we say, can understand what you're saying about this acquisition ACM that's on our chart
right.
for those, okay.
Sure. So again, in some cases, we are combining a strategy to go from a dedicated exposure, call it developed only exposure within international equities, to a broader mandate. So in the case of, for example, strategic global advantage, SGA, right? We're saying move to an ACWI ex-US mandate away from the current IFA only mandate. In cases where we say eliminate, we're proposing that you terminate those relationships, either due to performance concerns or the fact that those positions no longer fit the structure we're trying to achieve. And those assets will be repurposed accordingly to meet the desired exposures going forward. Okay. And then the balance of the table suggests we maintain the rest of the positions. And those managers will be maintained in combination with new managers that we have identified through the search process you've gone through over the last several quarters. Is that helpful?
And we will receive, the trustees will receive a culmination of all of these movements and where the movements will go. Exactly.
Yes, we can certainly provide that.
Thank you.
Sure. You're welcome.
Thank you, and hopefully this won't blow up on me. So just to reflect on that question as well, this is not gonna work. I don't want to keep doing that. Okay. Just at a high level, sort of to echo what Angel's saying, what we're trying to do with this is to decomplicate things. So you've got a bunch of managers that are all in this portfolio trying to do one thing. And you saw some of the misfit risk and that kind of stuff. What we're trying to do is say, we've got some very high quality managers we can concentrate in, and we can get rid of some of the complexity without losing the opportunity to perform the way we have and maybe even improve that. So I think, so to some of your questions about we're eliminating this manager, we're expanding the mandate, all of that is towards the goal of saying, let's focus on the good managers that we really appreciate, and let's maybe reduce the number of managers and get back to our knitting a little bit. So this is a process a lot of people go through as you get managed in the portfolio, and then you want to focus back and get back to your knitting. So this structure is sort of to simplify things a little bit without reducing the effectiveness. And that's what we're trying to do. So if you go to page 7, this is probably the simplest chart of the whole book here. And it's basically, if we can, yeah, if we can move one page forward. The idea is structure one puts almost 50% of the assets in core, which core is just another word for they stick to the middle of it and they'll move their allocation based on where they see the opportunity. So that decision of saying we want more growth or we want more value is in the manager's pocket, not the trustees, which I would argue is a good thing. Because the managers can be more nimble and they're probably closer to the markets to make those decisions than we are with the way we're structured. So if you look at structure one, it's 48% core, 20% value, 20% growth. So, and then we have that in all situations, we have 12% in the small cap international. So the idea is let's put a lot in core and then balance value and growth, and we still have our small cap. Structure two is keeping a solid core, 38%, and then a little bit more in each value and growth. So you've got the core, and then you've got a little bit more, 25% in each value and growth. There can be arguments made for both. I think as you'll see at the end, we're probably gonna, I would advise, and I think it's our thought here is that structure one is probably the most effective to do that. But both structures are completely appropriate for this portfolio. So I'll walk you through a little bit of that. So does that make sense of what we're doing here up front? Okay. Let's move to page 8. Now this is the complicated version of that chart you just saw. Basically, it's very similar to that last chart that Angel went through, where we've got the managers on the left, and then on the right-hand side, you've got 4 different options. It's really 2 options with an alternative in each one. And the main alternative is whether we keep Ariel and add basically one more value manager to that value group. I think arguments can be made for both. Obviously, a good manager, and we are reducing the overall complexity. So having an extra value manager does not reduce the impact of the work that we've done and the work that we're doing here. The interesting thing is the data below it, right? The managers, we have the weightings and you can see those, and that's more the logistics of it. Really, the interesting thing is what is the result of this restructuring of the portfolio? And if you look at those statistics down below, it's the same data that Angel was referring to on the other chart. And if you go to the styles versus benchmark, that's probably the most interesting one. Basically 0. I mean, that's less than 1% off of what the benchmark is. So we're getting rid of that unintended or undesirable risk of being not on your benchmark. So that, to me, right there is reason enough to go through this process of reducing that risk, reducing the uncertainty, reducing the why are we not performing like the benchmark? Oh, well, growth did well. This is saying you're going to perform closer to the benchmark, less surprises, and do it in an efficient manner. Another thing to look at on this page is, all of the rest of it really lines up. MWDBE managers goes up as Angel recommended, and we do applaud the efforts of this committee. It is not an easy thing to do, and you are executing it well with some exceptional managers. So you'll see that actually increases in every opportunity here. So I think it went from 36 or 38, 36 to a maximum of 44. But really, every one of these will increase that, which is a great outcome as well. The fees, I think we add 1 basis point or 0 basis points because we're combining managers. So as you combine managers, some of the assets for specific managers will go up, so your fee goes down. So even though we may be going to a few managers that have higher overall, what I say, sticker, what's the car sticker say? Once we negotiate down because we have larger sizes, we're able to keep the fees the same. So basically, it's a basis point off. The fees are not really impacting, even though we are focusing on some higher conviction and higher returning managers that I think we all appreciate. So I'm not going to go through each column. The thing I will say, and the first column, Alt 1, that's more core, less divided out. Alt 1B, same thing, more core, less out, but we include aerial as an additional value manager in the portfolio. Alt 2, less core, a little more spread out in the value and growth. That doesn't mean we're getting away from core. It just means that you're going to have, you're going to have outriggers that all equal the core. So at the end of the day, the exposure is going to be the same. It's just you have managers that are specifically focused in those areas, and they will stick to that. And then Alt 2B, same scenario, adding another value manager and aerial to the mix, while maintaining that sort of 35 core, 25, 25, and 12. So I know there's a lot on this page and we could dissect it, but the highlights are fees remain the same. We're reducing some tracking error significantly. We're concentrating in our high conviction managers. And at the end of the day, we're simplifying the portfolio to focus on the benchmark that we are all seeking to beat. Any questions on page 8? There's a lot there, but hopefully the key is the takeaway.
If you could just clarify under styles versus bench, the 5-year average core has 0. Why?
Because it does not vary from the benchmark. This allocation, basically, if core was 10, that would mean we have an overweight to core at the expense of either value or growth. In this case, core is 0, so we're spot on core. And then value and growth, you can see the value is up 0.2, growth is down 0.2. So there's a little bit value, but I could argue that's statistically insignificant. But the key there is, as you highlighted, 0 is what we want. We want that misfit to be 0. We want to be right on it. So that's a good question, and thank you for highlighting that.
Just a question to clarify, with the 0 misfit or near 0 misfit for the strategies, how do the managers achieve alpha since there's 0 difference between what the style is and the benchmark?
Right. So these are all active managers. So active managers, they realize they have a benchmark and they figure out the best way to beat that in their thing. And usually it's by selecting a subset of their benchmark. So the ACWI's got, I don't know how many thousands of stocks. I don't even know. A lot. Let's just say it's the whole investable universe. So there's a lot there. What this manager will do is say, I'm going to put a portfolio together that has the same sort of, when the market goes up, up, when the market goes down, down, when value is good, growth. So it has the same characteristics of the benchmark, but just with a subset of those stocks. So it may have, instead of let's just, for simplicity, let's say the benchmark is 10% core, 5% growth, 5% value. There's 20 stocks in the portfolio. The managers or active managers may say, I'm going to pick my favorite 5 core stocks, my favorite 2 value, and my favorite 2 growth. My exposure looks the same. So I look like the index from a characteristic, from a value growth core, but I'm picking the stocks that I think are going to beat the rest of them. So that's how they get that alpha. So it's any alpha is derived from having sort of a subset of your benchmark and not investing in the stocks that, frankly, the bottom stocks that no one wants to invest in, they don't have to be there because they're active managers, where a passive manager has to have the whole index. They have to buy stocks that they may not even like, but that's where you're getting your alpha from. Is that helpful? Any other questions? Yeah.
Okay, I guess it's more of a statement. You had stated, and I say you collectively, that we would receive a sheet or page regarding where the acquisitions would go that are being taken from here to there.
Yep.
Now, this is not, and I'd say as a trustee, my expertise is education and some other areas. But the idea is that when you present that page that you're talking about, can you also present this page of terms? So that when we're looking at page 6, 7, and 8, we're looking at everything. So we have the page of the terms that you're using here that we're not familiar with. So we can kind of go back and forth. And then we can look at this, at the chart that you have on page 6 and the chart that you have on, the 7 and 8.
Yeah.
Which are, you've already, produced these charts, so we'll have them in line.
Yeah.
And then, so the chart that you are really going to compose for us is where these acquisitions would go. And so, as we say, we don't want to be expert in your area, but we want to understand what we're looking at.
Yeah.
Correct?
Yeah, no, thank you. And I think just to make sure that I understand the question,
Mm-hmm,
it's basically taking page 6
mm-hmm,
and the map to getting to where the final portfolio is.
exactly.
Okay.
But we also need the terms, so a sheet of terms.
Yep.
So we can, kind of understand exactly what we're looking at.
Yep.
Thank you.
Okay, no, thank you. That's a very good recommendation.
Mhm.
There's-
Yes. So Tony, you were talking about on page 8 on Alt 1B and 2B, that was, if I understood you right, that those were rolling in aerial into the mix. And I
did it backwards.
Okay, because,
Alt 1 has aerial, Alt 2 does not,
okay,
or B does not.
that's the way I understood it. Okay, gotcha.
Sorry,
Okay.
I did it backwards as I'm looking at it now. So the first recommendation would be to include the value manager. If you wanted to further synthesize it, you could go with B. I apologize.
That's
Thank you
okay.
for catching that.
Wanted to clear it up. So Alt 1 and Alt 2 roll them in.
Yep.
Okay.
Okay, sorry, I misspoke. Thank you.
And sorry, Tony, just going back to page 7, just to point out that we have a typo on here. So that structure 1 and 2, it shows it foots to 100. What's missing there is international small cap. Tony pointed that out. 12% is in international small cap, but the rest, the 48%, 2020, that is in ACRI ex-US, and that's the difference between the two portfolios. The international small cap will stay the same at 12%, whatever option we go with.
Thank you. All right, so thank you for the mapping thought. That it's something hopefully we can try to do with our words a little bit, but you're right, having a chart would make it a lot more simple. Let's look at page 9 to give you an idea of what we're talking about, sort of how this all would fit together. If you look at the darker blue, that's your US value managers. And interestingly enough, if you look at the chart, you've got core in the middle, value left, growth right. They're towards the value side, some more than others. So, as you look at LSV would be the most value of the value managers, and Ariel is like somewhere between value and core, which is good. There's no judgment there. It's more of that's what they're doing. And our goal is to take their natural characteristics and put them together in a portfolio that looks like the equity. If you look at the green ones, the core, those are all right on the core. And then the growth managers, Bailey and William Blair, are out to the right. The key is at the end of the day, you put it all together and you're going to get that these all look like equity when you put it all together. So that's the goal. But this gives you an idea of where they all sit on these spectrums of size going vertically and value versus growth horizontally. Any questions on this, or does anything stick out?
So I guess I'm going to say it a different way. Let's see, make sure I understand it right. So there's a purpose to allocation. And then within that, we're talking about eliminating these tracking errors. So you have some variance within picking your managers and how they perform, depending on where they are on a graph like this. But you don't want to overdo it because then that starts undoing your allocation purpose.
Yeah.
So you just have some wiggle room, don't do too much. Okay, so that's basically where we're at. We need to make sure we're staying within certain parameters or we're gonna take unnecessary risk and undo the allocation. Is that, so I got it?
Yep.
Okay,
Because that allocation decision is made by this board. If we want a certain amount in equity, we don't want to undo it with our structure. So you're spot on with that. And that's what we're talking about here is the structure of how we put forward that allocation.
Just maybe another, oh, I'm sorry, go ahead.
And I don't know, just, oh, thank you. I don't know how to say this. It almost appears, and I don't know, so let's clear that up so I can understand it better. But it seems like this is almost a custom design plan. Because when we had the first discussion that whatever the debate was, it should have been in closed session, it should have not been in closed session. We were hearing something different about Ariel. Were we not? Or there was a recommendation and now it seems like it's changed. And we're kind of sort of custom designing this whole plan so that they are a part of the picture.
There's two options there. And I think with Ariel,
I can barely hear you.
I'm sorry.
It's okay.
There's two options. And Ariel, is a good manager, very high quality, and they've had some changes and that brought up some concerns. So, and I think in my understanding and being in these meetings is concerns and there's both sides. So we wanted to make sure that we provide this committee with the opportunity you can resolve that in any way you want. But I think at the time, there wasn't a specific direction of we want to keep Ariel, we want to get rid of them. So they are included in this as an option for that purpose. Is that
Right.
fair enough?
Yeah, thank you. The picture's a little bit clearer, but then again, and this happened back, and I just read something recently, and I was on the board 2008, 2009 with Ariel also. And it's over the years, 2009, 2024, we're still kind of wavering, they do well, they don't, they do well, they don't. And it seems like they should,
First thing I'll say is that's not uncommon.
pardon?
It's not uncommon. So investment managers go through good periods and bad periods.
Right.
So for that to be a discussion, an active discussion, is always going to happen, no matter
Right.
the manager. So that it happened prior does not surprise me. But I would say that about most managers.
Right,
The
but
key is how they resolve the issue, right?
Right.
And that's so we have one quarter's worth of track record and
But overall, I guess what's interesting to me is that the recommendation that was made back then, and that was to terminate them, and then it went back and forth, but it came from the consultants. You guys are the experts. We can be on here for years, and certainly I see things. But, it's a little, we can't have it both ways. Where they're going to take I'm sorry, did you want to? I'll say I'm sorry. No, I thought you had a question. We either take the consultant's recommendations or we don't. We pay a lot of money, that, we're paying a lot of money in fees and that, managers and that. So I just want to be more consistent. We take your recommendation or not, because it's almost like, we're classroom teachers, you have a bad student, you go, don't worry about it, we'll let it go, and then it builds up. And I don't want any of us to be in trouble and say, see, we should have listened to the first recommendation, we should have listened to them.
we don't want that either. I think.
Right, yeah, and then, no, I'm sure you agree, I'm not saying,
No, but I think Angel, you
Yeah,
want to
just
talk a little bit
maybe
about the strategy?
I'll add a few comments just to help address your question, which I think
Thank
is a
you.
good one. So taking a step back, right? Ariel experienced a portfolio manager change. with respect to the strategy that's present in the portfolio today. You have a policy that says we're going to monitor qualitative and quantitative issues to make a call on a manager, right? That is a significant qualitative issue. When your key portfolio manager leaves, that's an issue. And we, as your consultants, we need to bring that to your attention, which we did. Ariel went on watch or had been on watch for other reasons. Now, it is my understanding that this went through discussions and there were some board members who were interested in evaluating Ariel a little bit more closely as we went through this structure exercise. This is why you see two options for each structure. 1A and 1B, 2A and 2B, one includes Ariel, one does not. Ultimately, I mean, we are all one team. We work together to monitor these managers. But ultimately, you have the discretion to make these decisions. So what we're doing is we're offering an analysis that includes Ariel so that you can make a well-informed decision as to, do we move forward with Ariel or do we move forward without Ariel? But the genesis of this is the fact that the key portfolio manager left. She left, and within a few weeks, a new person came in. Brianna and I talked about this at length, and we didn't know what to expect out of that strategy going forward, and therefore it made us both nervous about this, and we presented the issue to the board. So you have now two options within each structure to evaluate with all of the data, all of the analysis that's relevant to make a well-informed decision. We do think that any of these structures make sense. It helps us achieve the ultimate goal, which is reducing that unintended risk exposure, that excess growth exposure you have today. And whether the board feels comfortable with Ariel or not, I think that should go through a vote and see what the outcome of that vote is. Does that make sense?
Yeah,
I will say, I heard you. Thank you.
thank you.
Thank you.
Trustee Riley.
We've had Ariel for a very long time and not always one strategy. In fact, I don't even remember when we first hired them. It was when I was an active teacher. And through the years, they have dodged the bullet so often that I think it might be interesting to make a different decision about them. Because I think the fund will be better off if we do. But as I say, it's been a long time. And if Lazard is bad enough to go, why isn't Ariel?
We're just trying to make sure that we apply the same policy equitably across any of the managers represented in the fund. Ultimately, we want to look out for the best interests of your fund and the beneficiaries of the fund.
Thank you.
Thank you. Oh.
I think we're ready to proceed.
Okay, sure. I'll finish up briefly. There is one more page, page 10, and this really just goes to show you that putting it all together, are we going to achieve the objective? If you go to page 10, that black box there, MSCI, ACWI, XUS, IMI, that's our target. That's what we're trying to hit with our darts. And if you look at the green and the orange, the funny thing is they're right on top of each other. Imagine that. They're very similar and they're very focused on core with a little bit of a bias towards large cap.
Tony, 1 second. I'm sorry. I just want to make sure page 10 on the screen for those who are following on the screen.
You're on page 10. He changed one up the screen, please.
Yeah.
No.
Yeah,
One
the
more.
pages
One
have
more.
two numbers,
One
10 and
down
16.
to-
No.
Nope, the other way.
No, the other way.
The other down. There you go. Thank you. So basically, this just shows you this is a proof point based on historical style. It matches up with what our objective is. And then you see the blue one there is the current. So bring it a little bit closer to core. A lot of discussion. I don't need to really go into a big summary. I think you know what we're trying to do. And I thank you, the board, spent a lot of time going through all of these managers. And it is paying off today, hopefully. So that's the goal. So thank you. Any questions?
Just a moment.
Oh,
Trustee.
Right. I'll wait till you
Rodriguez
get it.
And followed by trustee.
Thank you.
Riley.
Again, I just want to make sure, it's like, if you have children, I don't know, something, or a teacher, sometimes you have to be a tough parent and say, this is what's best. I know this is what you want, and I can bend a little bit for you, but this is what's best in the long run, and that's what I want to hear. I felt that the first discussion, you guys were firm, but again, we're the trustees, but I have more respect for somebody to say, you know what, trustee Rodriguez, I get what you're saying, but I think this is what's best, and it's best, in the long run. And I appreciate your explanation. You really broke it down, so I have a better understanding. I'm still not quite sure, there's things I see because maybe the history that I've been here, and second longest, I guess, to trustee Riley. And there was something else I was going to say, I forgot, but some of you just have to be tough and do it, because I want to make sure that everybody gets the same opportunity. There's another money manager who's almost in the same position, but we did not custom design something for them. That's the bottom line. But I appreciate all of you, I really do. We seldom talk, you're always so busy, but I do appreciate all of you. Thank you.
I'll wait.
Yes. Trustee Riley says she will defer her questions.
Okay.
And that concludes our
Yeah,
prepared remarks.
that's our prepared remarks.
I'm sorry, I have just one more question, just so that I'm clear. So we were looking at the info, the alternatives. We're looking at the different companies and where they are and everything. We have these two options with aerial and without aerial. And to the point that you just made, they did have a management adjustment. And so far, that management adjustment is appearing to be working to our liking, so to speak,
I would say,
or producing.
I would say the portfolio is different.
Mhm,
I would summarize it that way. It's a
Okay.
different portfolio today.
mhm,
So if you recall before, the portfolio is very defensive,
mhm,
getting into some technical jargon, very low beta exposure. So if the markets went down, it protected. When the markets went up, it didn't do well. That has changed a little bit. The beta
mhm.
exposure is higher. So it's different.
And so because the beta exposure is higher, it hedges better in both ends?
It is probably going to participate a little bit better in up markets going forward. And it will not provide as much protection theoretically going forward, because you now behave a little bit more like the benchmark.
Mhm. Okay.
That's what you saw in the first one.
Mhm. Okay, thank you.
More balance is balance out against all the percentages that we have here. It's all the way low, so. Yes.
Yes, and you just answered what I'm sitting here thinking, is that from what I was getting from what you're saying, is that they're doing well with the new management change, et cetera. I mean, they're doing, you know what I'm saying?
Yep.
They're still moving forward.
I would say that.
Uh-huh. And that's kind of where we are. So we're not eliminating out of elimination just because. And we're thinking in terms of the total picture of what's going on. So whatever was discussed maybe 3 years ago or 2 years ago, it may not hold clear for today, 2024. So we're looking at everything on a level of today, 2024. And so I just wanted to clarify that, perhaps in my mind and perhaps in someone else's mind, that, whatever happened and was ever talked about, conversations change every day. And we look for that conversation to change every day. Thank you.
I just have a question / statement. We are not married to anything. So if we see that things are not going in the direction that we assumed they would go, then we could change it. This is a whole new ball game right here. This is just a fresh look. So I would just like us to keep that in mind, that this is not the end all and be all. So, and I really appreciate the presentation and the detail of your explanations. And, but I just like to make sure that we keep things in perspective, that even if you marry, you can get a divorce. Okay. So, I'm sorry, y'all. You ain't never getting married, Philippe. So I just wanted to, just make that clear. That, you know what, I mean, it's not, they don't even say that anymore, till death do us part. So, just wanna make that clear, that right now, this is something new, something fresh. I can't look in the rearview mirror and live my life that way, or even look at investments through the rearview mirror for information or historical information. But right now, this is something that we're doing that's new, it's very new. And we don't, and that's why we take risks, because great risk yields great reward. And less risk, you say, well, just stay there in that one spot, and you're scared to make a gain, and you're scared to lose a bit. So that's all I have.
Fernando, do you have any wrap up
Yeah.
before they vote? Fernando?
Well, no, I'll leave it up to the committee to make a motion, yeah.
Question, I'm sorry. Why was it, and for everything else, we usually have a request, or we have a motion in place. Why was this not in our packet in advance?
Because we're discussing this, and this is what we're looking
Uh-huh.
at. Remember, we're at the conclusion of this process of international equities, where we would
Please
go-
unmute your mic.
I'm sorry. Therefore, I thought I talked loud enough.
Include agenda. It's in the agenda.
Yeah.
It's in the agenda.
Yes, exactly. So it is on the agenda, but what I'm saying is that we had to have all this discussion. These are the options presented to us by Callan. It would be inappropriate to
I
have a
agree.
motion, because a motion determines that we're making a request. The trustees are going to make a decision here based on the information presented by Callan and our investment team.
And that's the way it should be. And I think previous trustee Tina Padilla bringing that up last time. But when we say we can't look back, in anything, we have to look at the history. Not saying that past history is going to determine what decision we're making today. But everybody knows you have to learn from history, or you make the same mistakes. So yes, we saw the history, but some of us just wonder, how far has it gone? Like I said, I want the same opportunity for any other manager, whether they're minority or non-minority, that they receive the same
All right,
opportunity.
thank you.
Thank you.
So we will proceed, and I will make a motion based on everything that I've researched, looked at here, and I would make a motion to adopt alternative 1 and alternative 2.
I'm sorry, could you repeat that? I'm
Oh,
sorry.
we're doing one at a time? Okay.
You're just doing one.
It's only one.
He said
Oh,
get the motion on
okay.
the sheet.
Then what
Okay,
you
I'm
want, A or
sorry.
B?
Yeah.
Oh, 1A. That's what I would like.
So do you want to
said
read
read it
what
again.
1A is? so it'll be-
Okay, approve international equity asset class structure recommendation, option 1A.
Oh, so it's already written, we have it.
She made the motion. Second. I'm sorry, when did you second?
No, I had a question.
Quinn has a question.
Okay, it's been motion to second, so it's discussion.
So you said 1A,
Yes, that's the first column.
the first column. Thank you. I didn't see an A. That's why I was like, what we talking about? Okay.
But it's.
Okay.
But it's assumed since it's.
Yes.
So
You're
it's.
absolutely right. Okay.
Right.
Thank you.
I know you handed, can you tell me the page number? And I know somebody handed.
Page number 8.
We're on page 8.
Thank
Okay,
you.
it looks like this.
Yeah, okay, thank you.
All right.
I know.
Just make
Yes.
sure page 8, more core, including aerial. Is that the right way to characterize this?
Yes,
That's
that
it.
is. 48% to be specific.
Because they have two numbers.
Do we have any more questions?
You said 12 international small.
And 12 international. small.
I am totally lost.
Seeing no more questions?
I'm sorry, 48, 20, 20, and 12, right? Okay.
Thank you. I see no more questions, so I would like to call the question.
Trustee Barajas,
No.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
No.
trustee Price Ward,
Yes.
trustee Riley,
No,
trustee Rodriguez,
No,
trustee Vincent,
Yes.
trustee Washington,
Yes.
please hold for the vote. 5 ayes and 4 nays.
Yep, that's what I got.
so you want to,
Yes, thank you. Thank you so much.
I'm lost.
Mhm.
John will be happy.
Yeah, so, and like I said, it's not in stone.
Right.
It's not in stone.
If that performance doesn't.
They all fall off the cliff again, they gotta go.
That's right. Absolutely. And that,
So the next item on the agenda is the review of and pacing for our real assets portfolio. That includes real estate and infrastructure. I would like to have Bernie first start off with a review of the performance, and then Lauren will go into detail about the recommendations for both real estate and infrastructure.
Thank you, Fernando. Good morning, everyone. And thank you for meeting us here to review the performance of your real assets portfolio. The performance will be as of the fourth quarter of 2023. We'll start off with a brief overview, and actually it's in page 47 of your books that you're looking at. If we can get the slides up.
having a little bit of a technical difficulty with board docs. So let's give it a few minutes on the back side, on the presentation side. All right. Yeah. Mhm. So you were able to get yours up in here.
You know what, normally when I come in, it connects right to the internet, but I wasn't connected to the internet, so I had to reconnect.
Okay.
So if you can't get that,
So we do have documents. Is everybody, all the trustees, can you get this up on board docs? No. Okay, mine's is up.
Is it worth doing something else until they've got this figured out? Because it,
Okay, wait a minute, here we go, we're here. No.
I never have trouble getting it.
I know. This is. Okay.
cool. I think they're gonna project.
Yeah, I think you can. Okay.
All right, I think we're ready to begin. We'll start with a brief overview of the real estate market and then move on to an update of the CTPF real assets portfolio. So if we go to page 47. Sorry.
It's not labeled 47. so you'll have
It'll
to
be
just-
4 in what's on the screen right now.
On
I
page
can-
4.
I'll translate. You focus on presenting. I'll do
Thanks.
the
Slide 4. Okay, yes, slide 4 on the screen for those who are following. Thank you.
47 in the board docs, 4 on the screen document.
Right.
Do you have a?
Oh, the hard copy that we
Oh,
handed out
oh,
Oh, the hard
that's
copy.
might be page 4.
Might be page 4 in there.
hopefully 4. If it's a separate presentation, it's 4. Okay,
Before, yes, yes.
I'll work
Thank you.
on the page.
Okay. So in the, and just to note, the real estate market overview is actually as of 1Q 2024. So that's more current, which is what we provided. So in the first quarter of 2024, appreciation returns across all property types were negative, reflecting the correlation in real estate values as a result of higher interest rates. Income returns, however, remained positive for the quarter across all property types. So moving on to sector performance, which is on the bottom right hand of the page. Overall office vacancy rates remained relatively elevated and increased slightly, but NOI performance varied greatly. Grocery anchored retail was the best performing sector this quarter as it has maintained strong fundamentals. The apartment and industrial sector fundamentals also remained relatively strong in spite of slight increases in vacancy and a slight decrease in NOI growth, sort of representing signs of normalizing performance in those sectors. Alternative sectors like self-storage and manufactured housing have also maintained relatively strong fundamentals. So moving on to the next page, which would be page 5 on the presentation for public view.
Does everyone have a hard copy in front of them at this point? Does everyone have a hard copy in front of them?
Okay.
Okay.
Okay, so we'll continue. So the Odyssey continues to have redemption queues because liquidity in the core market is not readily available. So on the following page, we also see that continued liquidity challenges continue in the near term, but there are small signs of improvement. So with that, we will move on to the real estate portfolio
So that-
performance.
8 in the hard copies, 51 in board docs.
Right. So the CTPF real estate portfolio comprises 10.5% of the plan's value, which is above the plan's real estate target allocation of 9% and within the plan's target range of 6 to 12%. Unfunded commitments total to a bit over 1% of the plan's value and include a few funds that are currently calling capital. Additionally, the plan committed to the follow-on fund of one existing manager after the end of the fourth quarter of 2023, and that was Heitman Fund 6 at $30 million, which officially closed last week. So on the following page, the portfolio remains diversified across US regions with an emphasis on the Western markets. Regarding property type diversification, the plan's portfolio is underweight office as compared to the Odyssey Index and overweight industrial and slightly overweight retail as compared to the Odyssey Index. The plan's retail exposure includes grocery anchored retail, which is a subsector that again has outperformed in recent quarters. The portfolio is also has a higher allocation to alternatives like self-storage and data centers compared to the Odyssey Index. So on the following page, we'll go into a bit more on performance. So this page shows that the planned sector allocations and manager selection have likely resulted in the portfolio outperforming over the fourth quarter of 2023 and also over the 1, 3, 5, and 10-year time periods relative to the Odyssey. Notably, one of the plan's recent commitments is to a manager that focuses on strong performing sectors like industrial and multifamily, as well as alternative sectors like student housing and self-storage. So it's worth noting that the underperforming funds are ones that are actually winding down their portfolios. So unless there are any other questions, we'll move on to the infrastructure portfolio. So if we'll move to
The real estate.
the real estate pacing and school
Just so we can, we'll follow the order of the
Okay,
presentation.
that sounds good. So actually what we'll do is Lauren Surdich will cover the real estate pacing so that we do the real estate performance, then real estate pacing, and then we'll do industrial performance.
Infrastructure.
Sorry, infrastructure performance, then pacing, which is actually the order of the documents that we have for you. Yeah.
So we'll keep following the asset class. So we're going to go to slide 23 in the hard copies, 66 in that's Scooch. So it's slide 66 on the board docs. And this slide shows a history of all that you've done within real estate since we began working with you on your real estate portfolio in 2016. So you have added a number of different funds, including real estate debt to the portfolio. You've continued to commit to value add managers. You've also allocated to a number of different MWDBE, minority, women-owned, diverse investment managers over that time. Also back in 2018, you restructured your core plus portfolio where you redeemed right around 90 million in capital out of the UBS Trumbull Property Fund and redeployed that into PRESA 2, which is a core plus fund, Clarion Line Industrial Trust, which is all industrial, as well as the Sal Property Fund, where you were a founding investor and receive a really nice fee structure there. So we move to the next slide. This is your pacing model for real estate. And this exercise we conduct annually so that we can take a look at what we anticipate your commitment level will be for the upcoming year. And it's really important to look at it annually because as we've seen with this year, transaction activity has slowed down. So if we were to look at your pacing model from 2 years ago and what we were projecting for 2024 versus what we're doing this year, because the market's changed, we need to adjust the model based on what distributions you're getting back, based on performance, what managers are expecting in terms of capital calls. So the results of that pacing model, and we target a 9% overall allocation to real estate within this pacing model, and a split between core and non-core of 75% core, so that's strong income producing real estate, and 25% non-core. And overall for the upcoming year, we're projecting that your commitment level should be around $60 million to non-core, which equates to about 2 funds, which is very much similar to what you've been doing consistently over the last number of years. And then also a 50 million commitment to core, which would be redeploying. Right now you're sitting in the redemption queue for JP Morgan. We're also expecting to receive money back from the UBS Trumbull Property Fund. So as we receive distributions from your core portfolio, we'd like to redeploy that in other areas of the core and core plus marketplace. So before I move to the formal recommendations, does anybody have any questions about the pacing model?
Okay. I'm sorry. Seeing none, we can move forward. Okay.
So our first recommendation is to consider allocating up to 60 million to the non-core space for the 2024-25 fiscal year. As we've done in the last number of years, the focus will be re-ups with your existing managers that you've formed strong relationships with that have resulted in fee discounts for you as returning investors. And also it has been a really strong track record for you with those managers that you've been allocating to. And also to consider a search for new minority, women-owned, diverse investment managers. You've had a couple of programs that have changed ownership structures, and we'd like to take a fresh look at the marketplace. We know there's some strong newer entrants to that marketplace, and continue to commit to diverse managers. Our second recommendation is to enter the redemption queue for the UBS Trumbull Property Fund. Currently, they have been on watch for a number of years, and right now you've been participants in UBS's loyalty fee program. Back in 2020, they offered a loyalty fee program, and also were projecting very little in distributions to those in the redemption queue at the time. And given the fact that your capital was going to be locked up over a long term in this core open-end fund, we elected to take the fee savings of participating in the loyalty fee program. That was a 4-year participation period. At this point, you're coming to the end of that loyalty fee program. And they have launched a new loyalty fee program that does not lock your capital in. So before, if you elected into the program and then you decided you wanted to join the queue, you were going to have to pay back all of that fee savings. They've restructured that with their new loyalty fee program. So the recommendation is to make a partial redemption. So to maintain an amount in the queue that they would pay down because they're making fairly small payments in their redemption queue. We want to keep you in the queue at a level that will not be, a little over being fully paid out on a quarterly basis, so you can maximize fee savings with the rest of your capital. I know that is a big mouthful. So does anybody have any questions on that recommendation?
I'm sorry, I'm looking at the Callan report because I don't think I have that because we're having, our technical difficulties.
Sure.
But when, on the page 17 of the, I guess actually from pages maybe 11, nope, I'm sorry. It starts under the portfolio summary. So they're like, color-coded, quantitative, color codes and all this other good stuff. But for the most part, even in the areas where it shows that the fund is not performing, it says that we're not doing anything. So at what point do we do something?
So that is current action required. So JP
Okay.
Morgan Strategic Property Fund, and that's that first entry where you do see that red.
Yeah.
You have entered the redemption queue for that
Okay.
fund. And we had identified, and I apologize, I don't remember what meeting it was. They've had, it was, so.
We've actually received distributions back.
Okay.
So in addition to their performance, they had a significant portfolio manager change. So at that point, we put them on watch and entered the redemption queue. Trumbull Property Fund is the fund that was focused on in that second recommendation.
Okay.
So you've been participating in their loyalty fee program. If you had elected to enter the redemption queue up until now, where your program is now matured, so they're launching a new program, the fee savings that you had locked in, you would have had to pay back.
Okay.
And the payout, that fund has been on watch for a number of years.
Okay.
The payout of that redemption queue has not been meaningful in any way, shape, or form. So at the time we made the recommendation for the loyalty fee program, that was essentially the one way to
Get something.
get some sort of dollars out of them.
Okay.
And so now what that recommendation for the fund now, that loyalty fee program has expired, they're launching a new one that doesn't include a payback of any fee savings if you decide to change your amount within the redemption queue. We'd like to keep enough capital in the redemption queue that you receive full payouts, because UBS pays their redemption queue down based on your percentage of the overall net asset value, not how much you have in the queue.
Right.
So we're trying to sort of play both sides here. So maximize the amount that you can get back in their redemption payouts while maximizing fee savings. So right now we're looking at a 10% of your portfolio net asset value redemption request, knowing that you're going to be on a quarterly basis probably paid out much less than that. They're paying down they estimate on a optimistic estimate, about 5% of their redemption queue to be paid out on a quarterly basis. So if you kept 10% of your net asset value in, you wouldn't get that all paid back at once. So you wouldn't be off balance.
Right.
And then your 90% of your net asset value would receive 22.5 basis point decrease in fees annually. Which
So this is just a 4-quarter thing, like 1 year?
ongoing.
Okay.
And
ongoing.
so we're going to try and keep that allocation. So keep you balanced. So your 10%, 10% of your net asset value will hopefully be in the queue and 90% participating in that program. And this right now, the loyalty fee program, as we know it. Of course, UBS could decide to shut it down at any time. We don't anticipate that given the significant capital they have in it. So that would be an ongoing fee savings until you're fully paid out of get out of it fully. So ultimately, between your JP Morgan redemption queue status and the new UBS, you should be receiving redemption payouts from these two core open-end funds. And so our final recommendation, which is a little bit more long-term because it is predicated on the ability to receive payouts from these core managers, would be to consider allocating up to 50 million to new core plus managers. And we would conduct a search for that capital.
Okay. Any more questions? Seeing none. I would like to move the first recommendation, and we will be moving them one at a time. So I would like to move to approve the real estate pacing amount of up to 60 million for 2024-2025 fiscal year.
So moved.
Thank you. I have a move a second. That is the page. It's on, in this book, the big number is 68 and
25.
and 25 is a
25
little,
now.
25, right. So it's been properly moved.
No, I moved.
Yes. Yes,
Does a motion out of a committee need a second?
that's the way we do it.
No, but
So,
I don't think anybody seconded it. I made the motion.
That's when we take a committee recommendation to the full board. It doesn't necessarily need a second, but in the committee setting, we need a motion and a second.
You made the one.
Mhm.
I second.
so we're gonna do them one at a time. So we need to call the question.
So did you make the motion or did?
Well, Quentin, I said I was gonna move them one at a time.
Oh, okay,
And I just read it so that you know,
Okay.
people could be clear on what we're talking about.
so Washington and Blackwell.
Washington and Blackwell.
Can I ask a quick question before?
Okay.
Get a presentation before
And
we
that's
vote on it.
here.
So we just vote on
Consider
one or two,
search
and they
for-
get a presentation.
I'm sorry, I'm
Okay.
questioning B, consider search for new MWDBE managers. Is that because we've lost some? Or you just want to add some? Because A states that we're going to give those who are already existing, you know, an upgrade or new help in monetary funds. So I just want a clarification.
So it's a little of both, because there have been within your current portfolio, for instance, the Bentel Green Oak, they were hired as a minority-owned manager. They were,
The name,
well, it was Green Oak when you hired them. They're now Bentel Green Oak.
oh, I get it.
So during the time that you've been invested in their fund, they're no longer minority-owned. I believe Oak Street's net lease fund, that was another one that status had changed. We also know, you have been participants in programs like Franklin Templeton that looks at
Mhm.
underlying emerging managers. There are some new entrants into that space, including ones that are minority and women owned. So thinking of it this way, the manager that would be sort of the Franklin Templeton role,
Mhm.
that's actually, there are programs out there that are minority women-owned managers playing the role of Franklin Templeton. So
Gotcha.
you have both, and there are some groups that we've been monitoring for a long time that have now, they previously only did separate accounts, now they've launched a fund. So it's partially
Mhm.
to consider, the status of those groups within your current portfolio, but
Mhm.
also knowing that the marketplace has broadened. There are new entrants with longer track records that weren't able to be considered in past searches because, maybe their fund wasn't, the timing wasn't right on the fund, or they didn't offer the structures that you invest in. So we are always keeping an eye on that space. So while you
So-
have a strong roster of managers, the diverse owned space is something that we see some new opportunities in right now. So it's to complement the existing.
And thank you, because I just need a clarification.
Yeah.
To include A and B together as one. Thank you. Mhm.
Call the question. Roll call, please.
Trustee Barajas?
It's for number one.
Yes.
Yes.
Trustee Blackwell?
Yes.
Trustee Nelson?
Yes,
Trustee Ochoa?
Yes.
Trustee Bryce Ward?
Yes.
Trustee Riley?
Yes.
Trustee Rodriguez? Trustee Benson?
yes.
Trustee Washington?
Yes.
Thank you. That's 8 ayes and 1 nay.
Okay, we'll move to the next item, approve the search for the new core/core plus manager. I would like to entertain a motion.
So made, so moved. I
Thank
mean,
you.
Sorry.
Thank you. All right, made by Mary Sharon Rod. I'm doing number 2, yes. Approve, okay,
Number 2A.
yeah.
Jackie, are you sure you read the first?
Sorry, just to clarify, trustee Price Ward,
Yes.
it's item number 3 on their recommendation. So
Hold
they
on.
recommended action item number 2, but we've already submitted to the redemption queue. So there's no need to enter that as part of the, as a recommendation. So that's,
So we don't
that
need to
action,
do that
you're
one?
right, exactly. So you went straight to number 3.
Number
Or
3.
number 3,
Consider
that's correct.
allocating 50
That's
million.
right.
So moved.
But is there a presentation? Okay, all right, thank you. Okay, I need these in order. How are we gonna do them?
Yes.
Okay. All right. Thank you, trustee Nelson, I appreciate that. They're looking out. Okay, then we're going to 3. Now, do I read this or this?
We didn't need a vote for 2.
We did not
We didn't
need,
it, yeah.
2 that you read is not mentioned that.
no, it's
This is
not.
different. So you do need this.
Okay, so
Yes.
that's what I
Oh,
thought.
you've got a different list.
This is the cheat sheet. And that's what I thought we were doing. That's what we planned.
Wanna read it?
Okay, I just read that one.
Oh, sorry.
So are we going to 3 on this sheet, right? Or 2?
No, This
To
is
number 2.
this is.
I just
this is
read
right.
that
Yes,
one, and we got a
that's right.
motion and a
Yes.
second.
It
Okay.
matches this 3. This is what shouldn't have been there.
Okay,
Yeah,
all right,
okay.
great, thank you.
Oh, okay. So what
So it
what
was
did I make a
correct.
motion for?
Trustee Nelson's,
Can she restate the motion?
This one right
Could you
here.
restate the motion?
Okay, here's the thing. Approve the search for a new core and new core plus manager. That's the right one, right?
Yeah.
Okay, okay. Thank you.
And it was,
And we got a motion and a second. Tammy, yes.
Clarification. So is that the elimination of UBS? No, I know we're doing 3, but if we're skipping, was 2 on the sheet,
Yes.
then we're eliminating?
It's happening
No.
already.
yeah, so
Okay.
That's,
what
It
Callan,
says to replace UBS and reallocate other core capital. So I'm looking at the word replace. So if I'm literal in what I'm reading, then I need to be clear.
yeah, so we are on that motion.
To replace.
Correct, eventually, yes. That search will eventually replace UBS.
okay,
That's correct.
so we're searching for new core and new core plus managers. So what's in your book says replace, okay.
Getting the money now.
It won't happen overnight, Trustee Nelson. We've submitted redemption. Depending on when they actually sell assets is when we'll get money back. But the replacement, because of the way real estate transactions are going right now, we don't anticipate it happening overnight. And so as we start to work our way towards getting redemptions, and when that starts to defease or go down in value, we actually get money back, we'll go out to the market and conduct the search. But replacing UBS won't happen overnight
I
because
understand,
they have to
but
sell.
replace and eliminate are one and the same in my mind, unless
Yes,
I'm
yes, just to be clear,
not
yes.
thinking clearly.
Yes, yes,
Okay,
yes.
thank you.
Are we ready to roll call?
Okay,
I think we're ready.
trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Abstain?
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
No.
trustee Vincent,
Yes.
trustee Washington.
Yes.
7 ayes, 1 abstention, 1 nay.
Okay, so thank you. If we advance 2 pages on the public deck,
Slide, it's 70 on the board docs and it's 27 in the individual Callan presentation.
so we'll move on to the infrastructure overview. So CTPF portfolio comprises 2.4% of the plan's value, which is just above the plan's target allocation of 2% and sort of in the middle of the target range for the plan of 0 to 4% for infrastructure. The unfunded commitments total to 0.4% of the plan's value and include 4 funds that are currently calling capital. It's also worth noting that the 2 infrastructure funds that CTPF committed to in 2022 have begun calling capital. So moving on to the next page, which should be 71. Just over half of the portfolio is invested in the US and Canada. Other markets include Brazil, India, and China. 59% of the plan's infrastructure portfolio was allocated to utilities, renewables, and transportation. So if we move on to the next page, as a reminder, the infrastructure sector is relatively new private real estate, private real asset property type. So there is not yet a standard private benchmark for the sector. So as a result, we compare the portfolio's performance to the public markets based on benchmark, which is more volatile. So over the quarter, the portfolio has reported positive returns and also outperformed the benchmark. So from there, we'll move on to the pacing.
All right, excuse me. We are on slide 36 in the Callan only deck, slide 79 if you're in board docs. And this is just, again, a reiteration of the pacing study process and why we do it. Because we want to keep you diversified in all numbers of ways within the infrastructure marketplace, including vintage years. And so we go through an annual pacing process, very similar to real estate, where we get projections from managers on their projected capital calls, their projected distributions. We take into account capital markets assumptions for the asset class and create a plan. So on the next slide, so that's 37 or 80 if you're in board docs, this is a map of CTPF as an infrastructure investor. So this dates back to when you made your first infrastructure investment in 2008 through 2022. You'll notice 2023 isn't on this chart because there wasn't a commitment made in 2023. If we move on to the next slide, which is 38 or 81, this is our pacing model projections. So we're projecting a $10 million commitment in 2024. Although we like to give, that's what's modeled into the exhibits on this page. We do like to give some flexibility, especially given that you didn't make a commitment in 2023, to allow for funds coming back, your existing managers coming back to market early. We're always on the hunt for diverse infrastructure investment managers. So if we move to the slide that has our recommendations, which is 82 or 39, our recommendation is to invest between 10 million and 30 million per year for infrastructure. We are going to continue to seek qualified diverse managers and also evaluate opportunities with any of your existing managers through what we call re-ups. So this is a little more simple than the real estate recommendations.
I will accept a motion to approve the infrastructure pacing amount. I'm sorry. I'll accept a motion to approve the infrastructure pacing amount of between 10 to 30 million for 2024, 2025 fiscal year.
So moved.
Excuse me, where are you reading from?
39.
Page
Page 39, we just.
Young lady knows.
Okay. It has been properly moved by Mary Sharon Riley and second by,
What page? We're looking for page.
So
37, that's why I missed, I'm sorry, I was looking back.
you
I
have
was
the
looking
board
back at that page 37.
yes.
And that's why I missed it.
37
Mhm.
there. The formal board action request is on 92 in the board
Yeah.
docs. I'm sorry, it's not 37. It is 39.
39.
It's 39,
Right.
right?
Got it.
You just told us to
Thank you.
turn to 39.
Thank
you. All right, so it's been moved in second, moved by trustee Riley. Okay,
Okay.
no problem. No, thank you.
I was looking at that page 37 and going over when the infrastructure was first started in 2008. Is that correct? I thought it was started before that. Because, I mean, was there some infrastructure before 2008? And I guess that's why I was concentrating on that particular page.
Okay,
Mhm.
So I believe that was the first infrastructure investment.
It was?
That
Okay, so it was after the crash of 2007. Then we start, you know what I'm saying? The stock market crash of 2007. Okay, I just want to be sure that that's, okay, anyway, so now I'm on page. Okay.
thank you. But
Okay, sure.
it has been moved in second, so I just want to make sure that Sharina has, okay. Yes, absolutely. All right, now we have questions. Trustee Benson?
I just want to clarify, it says that the recommended investment between 10 to 30 for 2024, 25, sorry. But here it says invest 30 million per year. So how is the investment going to be structured?
it invest up to 30 million per year. So our model shows 10. We'd want to give flexibility because again, you didn't commit last year. We had modeled a similar commitment size last year. So this just, it'll be based on opportunities. Again, we won't exceed 30 million and we will, if the fundraising marketplace is similar to this year, we might not place capital again. So it's to accommodate a little bit because we're in the closed-end fund marketplace and we haven't, similar to real estate liquidity, infrastructure managers haven't been transacting and making big distributions. So we want to, it's that art and science of making sure there are managers in the marketplace to commit to that are appropriate for your fund and making sure that you've received the distributions we can redeploy and accommodating if multiple of your managers come back at once because all of a sudden maybe they're ready to capital raise again. We don't want to miss that opportunity too.
That's fine, but I would, just listening and being new to this, it seems like a lot of the strategies have like a time frame, like a 3 to 5, 10-year period. So what's this strategy is gonna, because 30 million per year for 5 years is not 30 million, it's 150.
Well,
what's-
that's why we do it every year. So this won't necessarily look the same next year. It could be up to 10 million next year. And that's, I mean, I think across the pacing study exercise, it's why we do it annually, because we want to make sure that we are capturing the market conditions of your portfolio when we do it, so you aren't over allocating. And so if you're not receiving distributions, this model could look different next year. And that's also why we try and the managers participate in this exercise to give us their expectations of what they're modeling right now for capital calls and distributions. So it's very specific to everybody's expectations right now. But again, that could be different next year. And it has been over the course of history in doing this exercise for you.
Thank you.
Yes, trustee
Thank you.
Rodriguez.
Which says continue to see qualified MWDBE managers. How much or how many, what's the percentage or?
Right now, the MWB, the diverse manager
know.
in your portfolio is JLC Fund 1. So we're monitoring their fundraising process for Fund 2 right now.
Okay.
We are also monitoring, there are a very small number of diverse infrastructure managers. It's a little harder to get those businesses off the ground given the size of
How
infrastructure.
small, what do you consider small?
I would say that there are no more than half a dozen. I mean, and I think that's not, and I'm not saying those are all institutional quality managers that are set up to manage pension fund money. I'm saying that could be groups that have family office and high net worth money, but I'd say around half a dozen. And we've been actively, Callan and your investment staff have been actively meeting and monitoring those because this is such an important piece of this portfolio that needs to grow.
So how do you plan to recruit them? They're difficult find and.
So Callan has an open door policy with our meetings. So we get inbound calls from managers to meet with them. Also, I know we've got 2 people within our real assets consulting group that cover the infrastructure space specifically. They're going out to industry conferences that a lot of these managers are attending and meeting them that way. They're participating, in different panels to try and make these connections. And I mean,
Just want to
yeah.
mention, and also, so what Lauren is stating is that we have an ongoing effort, right, to seek out diverse managers in real estate and also in infrastructure. Other ways is really networking within our industry. And then also Callan has a program called Callan Connects, where for those managers who have not maybe had a chance to interact with us, we sort of make sure across our company that they are set up once a quarter with a call to speak to some of the consultants directly. So we have sort of a multi-pronged way, and including what the efforts of the staff as well, to sort of canvas out continually the infrastructure landscape so that we can find and learn more about those managers that are out there.
Because you said there are rare and few and you have a little bit more than a half dozen. So if they don't exist, how,
We're sort of doing the best we can within those parameters.
So the 30 million per year, that figure, I mean, it's, when we say 30 million per year, more than likely we'll invest 30 million, correct? Or more?
It will, no, not more. It's up to 30 million and I believe we're pretty.
But do you usually, is that
constrained to
so that's what we're thinking of, but do we usually hit that earmark of that 30 million, or is it we write 30 million in there and we're only investing 25 million?
It will depend on the marketplace. So I believe a similar amount was approved at this time last year. I think it was 10 to 30 million. And we actually didn't make any commitments to infrastructure this year because none of your existing managers So in the last year, we did not make any commitments to infrastructure. None of your existing managers came back to the market with fundraises. And there were we've been monitoring, we've been monitoring the JLC's portfolio. I think that would be one potential, but no one was ready for capital over the last 12 months. So it will have to be, it's that match of opportunities in the marketplace and your available capital. And so we could end up doing less than 30 million. 10 million keeps you continually in the range, but the nice thing about your program is you are well allocated to the infrastructure asset class right now. So you're not trying to play catch up to hit your target.
Yes. Trustee Nelson.
I'm just noticing that Macquarie has several of your investment opportunities at this point. There are at least, what, 4 with Macquarie? So would Macquarie be given funds from what you're doing now? Or is this all new investments with what you do, the funds that you're requesting at this point?
So you last committed to Macquarie in 2022. They are still calling capital for that investment, so they should not be back in the marketplace quite yet. So my guess is no. It's not the right timing for a new Macquarie fund.
So you're saying that the new investment will go into your quest for new funds, new funding?
Right now, I think in your existing portfolio, there would be potential for JLC Fund 2. That's the one right now that that has the most re-up potential out of the existing managers.
Because I guess like Trustee Denson has responded to that 30 million per year. And it says that perhaps we can possibly have a specific that you plan to do each year, that you come before us instead of up to 30 million. That's kind of, in the air.
I think we try to, we identify JLC in the recommendation page. I think the sort of fuzzy part of identification is those groups that we don't have visibility on right now that may come back to the market, say in March of next year. So we're happy to put in as much visibility as we have on the existing portfolio. And then.
But dealing with specifics, that's kind of where we are.
Yep. And we try as much as possible, but again, with the fundraising environment, sometimes there's a little bit of guesswork in that.
And again, Trustee Nelson, once we identify something, we will have to bring them back to you anyway for final approval.
I'm thinking as educators, what we hear is 30 million each year. So as Trustee Vincent clarified, so I think it's a semantics kind of thing. So I don't know if this is your practice or this is how you have to present this, that 30 million per year. I think that's where the issue lies.
And again, just to reiterate what Lauren has already stated, it's part art and part science because there's a lot of unknowns, and this is why we do this every year, and it's a moving target. So there's some years where, because of market conditions, which nobody can control, funds will return a lot of capital, and then we're under allocated and we have a lot of available capital. And so in that circumstance, we will have to adjust the model for that year when we have this discussion and say, because of different circumstances, we may have to allocate a little bit more. It might be prudent to do that to keep our target. There may be other years where it's the exact opposite, where we don't get a lot of distributions back and the market is underperforming and now we're over allocated. So we may not want to put out as much. The model may spit out a number. I shouldn't say that, but I mean, the model may output a number that says, you don't do as much this year. we don't try to be too cute around that, and Callan doesn't try to be too cute. I think the important thing, and we've tried to implement this in all of our private asset classes, whether it's private equity, real estate, infrastructure, because of these unknowns and because these are longer term assets and illiquid assets, we're trying to be consistent. We're not trying to make huge market calls. Yes, we will toggle around the edges. If you remember last year, because of market conditions in the public markets, we were temporarily over our target for real assets, okay? Rather than try to hit or miss that target, we said, look, that's just a temporary function of the equity markets are down, fixed income markets are down, real estate, partially because it's on a leg and partially because it just maintains its value. We're now over allocated. Well, we didn't go out and say we're going to sell and try to hit this target. We said, let's just wait. Let's try to consistently put out more capital because we don't know when the next opportunity is going to come. And that has been a much better model over the last 8 years than I think trying to guess, do 100 million one year and do 30 million. We're trying to be within this range. So yes, I think when we say up to an amount, we're trying to maintain as much flexibility. We may get up to that amount. We may do less than that. But the two important keys are we will never go over that amount because we would have to come back to get approval. And any decision that we make as far as actually allocating capital, we're going to be back before you to say, okay, you approved up to this amount. Here's our recommendation for a portion or all of that amount. And that has to come before the board. So this is just a framework. It's a guideline to give us flexibility throughout the year because, for this year, if Macquarie and let's say Brookfield, which is another one of our closed-end funds, if they surprise us and said, hey, we're coming out with our next funds, we would want to take advantage of that. And so then we may be in a circumstance where that 30 million is enough. We would have to come back, but we can't predict that right now. Right now, it doesn't look like that's going to be the case.
Your mind, just really quick, but it seems like you're not, because when I made the, $150 million question, you're just essentially recycling the money that's already been allocated, because you mentioned something about getting capital returns and reinvesting. So it's not like you're constantly going back to the bank getting a check. It's like you're just reinvesting some.
Yeah, it's a combination, and what we get back is obviously a factor because part of the liquidity that we get from all of our, the entire portfolio goes out to pay distributions. So we're always trying to match as best we can from a cash flow perspective, yes. But there's always going to be a need, to allocate new capital. Now, where that come from? It could come from, capital returns from the existing portfolio. And in fact, that's ideally what you want to achieve with these closed-end portfolios, where you're taking capital that managers have invested wisely from the previous 5 years and are now returning to you so that you don't have to take from other areas.
Trustee Nelson.
It would be, since we are in, trying to get the most in investments that we can. That's why I asked certain questions. And in terms of Macquarie, now in 2007, I'm sure they came forward, through our process, but perhaps they didn't get the money till 2008. But the thing is that I'm near the Indiana toll where they are originally. At any rate, and now they're charging like $5, I think, to go through. So my question is, the investments that come back to us, can you give us, some little summary of how the investments are going? Because our thing is investments.
If you, the performance we went through today, but if there's ever any specific questions, absolutely let us know. Because we're talking to these managers. Callan is talking to these managers.
Right.
On an ongoing
Just an update, on how they're doing, because we're paying more to get through. So the question is, yeah.
That's what we had today, but I think you want to dig a little deeper.
Yes.
And that's what John's offering to you. Okay, so we're going to wrap this up now. We have had a motion. In a second, I would like to call question.
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
Trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Bryce Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
Yes.
trustee Vincent,
Yes.
trustee Washington.
Yes.
Thank you. Unanimous.
Thank you.
Okay. So the next item is Mesro Co-Invest Fund 9 re-up. I'll be brief on this. We've had a relationship with Mesro dating back to the late 90s. We've invested with them in several different forms, both in their fund of funds, secondaries, and co-investment. I'll have Summer come up briefly to go over their track record. But we've got representatives waiting to also present directly to you. We're giving them 15 minutes, 5 for questions. They're looking to raise 500 million. Because of the nature of co-investments, the overall fees tend to be a little bit lower, as well as the carried interest. And Summer, can you just briefly give us an overview on their performance so far?
Yeah, definitely. In the memo, thank you. And I have some additional, we have some additional information. Oh, sorry, is it better? Great. So as third quarter last year, we invest in 10 funds with the Mesro and 5 funds in partnerships and 5 funds in co-investment programs. So as a composite return, Mesro generates 1.74x TVPI net and 8.95% on net IRR. And the DPI is 1.41x. And total outperformance to the public benchmark is about 317 basis point. So 5 funds in partnership generated 1.6x TVPI and 7.13% on net IRR. The DPI is 1.37x and co-investment as a composite return 2.03x and 16.15% net IRR, and the DPI is 1.45x. So they return very well as the track record. And we don't have too much issue with the performance.
And just real quick, they mentioned that the 2 most senior team members, Mark Sachs and Tom Galloon, will be retiring within the next 5 years. That's why I pointed it out as a matter that they'll be discussing as well, because that's they were key to forming the private equity team. And so what's the next generation look like, and who's taking over? And
Who was the first name?
Mark Sachs.
Oh, okay.
And then Tom Galloon is
Tom
also a
Galloon.
senior advisor currently. So I'll bring them in.
Morning.
Morning.
Yeah.
Oh, so nice.
Good morning.
Yeah, long time.
Way.
Right.
Well, good morning, everyone. My name is Tom Hines. I am a senior managing director at the. What do I do? Push this? Is that right? Oh, there it is. Okay, thank you. My name's Tom Hines, Senior Managing Director at Mesero Financial. With me is Bob DeBolt. Bob is the Chief Executive Officer and CIO for our private equity division. And on behalf of Bob, I'd like to thank you for inviting us to present our private equity capabilities today, and specifically our latest co-investment fund, the Mesero Financial Private Equity Co-Invest Fund 9. And I also want to take a second to thank you for the long-term partnership that we've had with the Chicago Teachers Pension Fund dating back to 1999. It's been a tremendous experience. We value the partnership that we have with you, and to be honest, we've learned a lot of things working with you along the way, and we'll get into that in our presentation. What I'd like to do before I turn it over to Bob to talk a little bit about our current fund as well as your past investments with us is, I know there's some new trustees here, to give a quick overview of Mesero, who we are, and specifically our private equity group. And really, in particular, talk about some of the values that we bring to the table as private equity managers in terms of diversity, equity, and inclusion, as well as our focus on labor and working rights for the employees of the companies that are ultimately in our portfolio. So as you may know, Mesero is a Chicago-based firm, so we have about 500 employees. There are about 200 shareholder employees. Bob and I and all the investment folks on the private equity team are all owners, so it's very widely dispersed. This is not a firm where a few individuals own the vast majority of the shares, and I think that philosophy of spreading the wealth is something that, you know, really kind of drives the way we approach all of our business units, including and specifically private equity. If you turn to page 5 of your the presentation, just a couple facts on the private equity group I think are important. You know, so since our inception, we've managed about $6.3 billion assets in private equity. That makes us kind of a mid-sized manager. And I think what's important about that is that Bob and his team have tremendous relationships in the industry to get access to some of the most highly sought after funds. But because we try and keep our assets to a maintainable level, a minimum level, you know, we want to be in a position where we can always be very selective about the managers with whom we invest, or the companies that we invest in. Not only in terms of who are the best investors, but in terms of issues about how they execute their strategy going forward. How do they look at, are they looking at growing companies, or are they looking at taking a company, dismantling it, and, you know, injuring the workers that are at the company? So we want to make sure that we are selective in evaluating these companies. So there's an org chart, and I'm going to let Bob touch on that because I know succession is an issue that we want to talk about. So I'm going to skip that page, but I do want to talk on page 7 very quickly about our view and effort on DEI initiatives at Mesero and within the private equity group. And I want to actually thank the board, the pension board, because you were probably the primary catalyst for us starting the program that we're going to talk about here today, because we came in front of you in about 2016. And I think it's safe to say that we got it handed to us because I'm trying to keep this PG rated. At the time, we were a lily white group. We had no diversity as a group. We had no diversity as a firm, and we got raked over the coals, and deservedly so. And I will say that I was one of the instrumental people involved in this program, but we started up in 2018, what we call our investment management rotational analyst program, where every 2 years we hire 2 very talented, diverse college graduates. I'm sorry, three. And we hire them for a 2-year program where they rotate around the different areas of our investment management group with the goal of, first of all, exposing them to the industry and various asset classes, but also with the goal, hopefully there's a match between a need in one of the groups and an interest on the part of the professional. And this program has been phenomenal. We're now just starting our 4th cohort of 3 students, and you can see them listed here. They're going to be starting on July 1st of this year. And importantly, you know, there are a number of these young professionals that have become permanent employees in our various investment management areas. And in the case of private equity, as you can see, the last 3 hires that we've made in the group have all been diverse candidates. And Anthony Darris actually came from our rotational analyst program and has been a terrific success story for us. So I think this is kind of a cutting edge program. We're extremely proud of it, and you know, looking forward to the next cohort of 3 students to come in. In addition, we also, I'm very proud to say our largest client in private equity is the Cook County Pension Fund. Fernando is very familiar with our work there. One of the things we did with them in this big separate account we have with them is create a women and minority owned program for the private equity sleeve that we manage. So, you know, with Cook County, we've invested over $275 million in minority owned private equity firms, and we continue to do that on their behalf going forward. So very proud of that as well. Worth noting a couple CPS grads on that page too, I would note as well. So proud of that. Yeah. Oh, I didn't mention that. Jonathan Pedraza is joining us in August, and he is a Lane Tech grad. And Jason May, who's one of our rotational analysts, went to Peyton or Jones. So keeping it local, which is good. On the next page, there's a lot of acronyms here. One thing I want to point out is an organization that I'm involved with called Link Unlimited. I'm not sure if anyone's familiar with it, but I'm on the board and I've served as a mentor of Link for the last 7 years. And we provide educational resources and mentoring to African-American students in the Chicago area. I will say, in full disclosure, they're both private school and public school students. They apply in 8th grade. Actually, we have a junior link program in 7th grade. And we don't control where they go to school, but you know, roughly half the students are CPS public school students. And in 2021, coming on the tails of the murder of George Floyd, you know, Mesereau stepped up and underwrote half a cohort of students for that class. So 25 students for the program at cost $100,000 a year. And we signed up about 30 Mesereau individuals signed up as mentors, including Bob and myself. Bob's student is actually a student at MLK College Prep. And so just another example of the ways that, you know, not only our firm, but the private equity group believes in, you know, in the diversity, equity, and inclusion effort. And it's something that, you know, has been with us for 6-7 years and will continue to be an instrumental part. The last thing I want to touch on, and Bob will continue with this, is just our approach to private equity investing in terms of how, you know, how we take into consideration a manager or a company's attitude toward labor. So on the next page, this is just a snapshot of our efforts in private equity on behalf of working with unions. So as you can see, since 1999, we've managed about $2.3 billion in assets for union affiliated pensions. Our latest funds, 8A and 8B, 60 and 30% respectively, were union pension plans. So we view plans that are affiliated with labor organizations as partners. This is a partnership. And so one thing that you can be sure of is that in our evaluation of the managers and investments that we look at, looking at their past experience and reputation of working with labor is going to be part of our screening process. And if we sense that they've mistreated labor or that they have a history of busting up pension plans to put in defined contribution plans, we are not going to invest in that company or in that manager. And so we are signatories to the AFL-CIO Principles of Responsible Workforce Management, Private Equity. That was an easy one. That was a no-brainer for us because that's what we've been doing anyway. So we're proud to say that. We're also on the corporate advisory board for NCPERS, the National Conference of Public Employee Retirement Systems, which is set up to defend defined benefit plans for public employees. And then the last thing I want to say is our approach to private equity. Private equity does not have to be anti-worker. There is what's called focusing on growth and focusing on investing and injecting money into companies to provide, that creates a rising tide that lifts all boats. So about 2/3 of our money that we invest go into very growth-oriented businesses, a lot of technology companies, software, IT, business services, things like that. So those are all, whether they're buyouts or growth capital, those are investments that are meant to provide the leadership and the capital to accelerate growth in a particular company, to expand the footprint, to expand, into other ancillary businesses, things like that. The other third are, companies that may be in traditional manufacturing, industrial, but what we try and do is to partner and invest in private equity managers that actually see labor as part of what can make them successful. And so I'm just going to bring up one example, and Bob will talk about another one. But tomorrow, I have a call with one of our large investors, the Painters National Pension Fund, and we're going to be talking about a company that one of their private equity managers owns. We did not put them into this manager, full disclosure, but they have a company in Indiana that makes glass. They're a glass manufacturer, and they just decided to kill their defined benefit plan and put the workers all into a 401k. And so Dan Pedraza, I'm sorry, not Dan Pedraza, Pedrati, who is the head of capital strategies for the North American Building Trades, has set up a call with a few select private equity managers to talk about this situation and brainstorm on how they can try and make a difference. Now, we did not invest in this manager, so we're there to kind of share ideas, but it's just an example of our approach to investing in private equity and how we like to partner with labor when we do it. The other firm I want to point out is called KPS Capital Partners, which is one of our large, very close private equity manager relationships and co-investment relationships that really is kind of Wall Street's, labor's representative on Wall Street. And I want Bob to talk about that because he's very familiar with this fund. He's the one that recommended we invest in it. And he can tell you like how they approach it and how successful they've been as a union-friendly private equity manager investing in these kind of traditional businesses.
Always a tough act to follow, Tom. Well, I'll hit on that in a sec, but I'll roll back a couple pages. Sorry, we're bouncing around, but page 6, just to hit the team real quick. So on page 6, you see a representation of the private equity team shown in dark blue, supported by this much bigger team behind us, amazing colleagues like Tom Hines, helping us raise our funds and, help our clients around the country. This is the best team we've ever had at Mezro, and I've been here a long time. So my background, I started in private equity in the late 90s, and I joined Mezro in 2004. So I just got my 20-year, I got a little piece of plastic on my desk that says 20 years. That's what you get. I became the CIO in 2014, and then the CEO of the group about a year ago. So, this has been a great journey for me. It's been great, having the great support of this plan to help us build the portfolios that we build for clients. So, there was a question on succession planning, I think, so I just wanted to hit that. So, because succession planning is something you do in like 10-year increments. And as I noted, I've been the CIO since 2014, running the investment team the last 10 years. Mark Sachs and Tom Galloon, who have kind of stepped back into more advisory chairman roles. It's been, that did not happen overnight. It's been a long multi-year process of transferring relationships. And in fact, all of the key relationships have now been completely transferred to myself and then members of my team beneath me. We continue to build the team. I am excited that the next two folks coming on board are both CPS grads and folks with diverse backgrounds. And we'll continue to build the team as we build the portfolios. So maybe just jumping to the track record real quick.
That's the time.
Is that a timer?
Yeah.
Oh, sorry.
Happy to take questions or hit on track record maybe next.
I was just hoping we can give just a minute to just wrap up.
Oh, thank you.
All
Okay,
right,
well, we can talk about the track record very quickly. Yep.
Let me just hit on page 12. So we are very proud of this track record. You know, in our business, if you're doubling your money for clients, you're kind of getting the job done. You know, we have close to tripled our money on our two mature co-investment funds that you see at the top of the page on page 12. Fund 8B is a very young fund, and we think it has the same potential as those prior two funds. You know, this co-investment strategy that you backed has been extremely successful. We think we have a terrific formula. The next fund we're raising, Fund 9B, actually co-invest Fund 9, I should say. We're not changing the formula. We have a great formula of investing only with elite private equity firms, getting into the same investments they're putting in their portfolios, but with about half the fees and expenses that they're charging their clients. So we'd be thrilled to have you back in the fund, and maybe I'll stop there and open to questions. Yes, please.
Sorry.
Trustee Nelson, yeah, okay, thank you. First of all, I'm happy with your diversity question, okay. At any rate, and I also was interested in how you're set up for your company as an equity is different from a lot of private equity. Because I remember many years ago with when Sears first was one of the first to go into it, they immediately discharged 5,000 employees, yet at the end of the year, their top persons receive bonuses. So how can you do that? And I see that that's not your focus. So I'm, pleased with that.
Yep.
So I like to, commend certain things that I see that are positive, because we talk enough about, the negatives.
Right.
And even your ESG, setup with in terms of IT, software, and a couple of your other areas are, if you can tell me.
In terms of sectors, so I'd say the
Your
largest,
ESG areas. I know the IT, areas. So
yes.
what else are you in that area?
So software IT is the largest thing that we probably invest in. Beneath that would probably be business services,
Okay.
healthcare, consumer, industrial, probably in that order.
So your business services, what is that?
It's a close related cousin to technology. I say it's often a technology related service, usually serving.
So that's under the
enterprises
same
in the US.
category.
Yeah, it's related.
Okay.
So it could
But
be anything
health,
from legal services to, supply chain services, usually serving companies here in
All
the
right.
US.
Thank you.
But the consumer, interesting for you, the consumer businesses that we invest in are very growth oriented. So one of the investments that we made several years ago that you were in through us was a company called Planet Fitness, which is
Oh,
the exercise.
really? Yes, we're
So
familiar with that.
this is the type of strategy we love, where you have a company that has about 400 Planet Fitness stores out in the Northeast, and we come in with a partner, in this case, TSG, which is
A consumer-oriented buyout fund, and they basically partnered with this family-owned business. It was two brothers in upstate New York to take the Planet Fitness story nationwide, and more than quadrupled the number of stores that we have across the country.
Right.
Obviously, hiring a lot of folks to do that, so that's the kind of story we like.
Now, see, you just opened up something, because one in my area has just closed. So, so how are they doing right now?
So we took the company public. It traded very well. We sold our shares. So we're out of that investment. We made close to 10 times our money, and that's part of the return that you had in your fund 10
But did they
investment.
combine with another company?
No, they went public, and they continued their growth story. I haven't really followed the stock, to be honest, lately, but it seems like the growth continues. It's a great formula.
Yeah, okay, well, just check it out for us.
Yeah.
Okay, thank you.
I think a number of those they had troubles during COVID because nobody was going to health clubs anymore. So I don't know if it was
I
a
believe
victim of
that because our son-in-law owns a couple of fitness,
Oh.
Fit Code at
Okay.
any rate. And so he had 4 before the pandemic and now he has 2. Thank you. Okay.
So,
Trustee Ochoa, just for the record, they want to get them.
sure. Just curious about co-investments and if you see a pattern of people going into those and then staying, are they staying in co-investments? Are they doing something afterwards? Have you seen any patterns or is there anything you can, I don't know how long you've had it either, and what you've seen growth, change through that process?
In terms of our investor base,
Yeah, I mean, I guess I can speak to that. So what we typically see is, a lot of our clients start with fund of funds, then they migrate to co-investment. And then if they're large enough, what they do typically is they may stop with the fund of funds and keep doing co-investment and then maybe pick a few direct funds around it. The interesting thing about the co-investment strategy is that the fees are so much lower than your typical direct fund. I mean, a typical private equity fund will charge 2.5% management fee and a 25% carry, the percent of the gains that they get to keep. Whereas a co-investment fund, you're going to have, 80 basis points to 1% fee and a 10% carry. So, if it's done well, and we have some very large clients that continue to invest in our co-investment fund, that can be a very good piece of a direct investment strategy. But we do see some migration from a fund of funds to co-investment and direct, because in that, if you have a staff and you're able to kind of evaluate and then manage the capital calls from all the different managers that you're investing in. So
I think the best fit for the co-investment strategy is, investors that are fee sensitive. They don't want to pay the incredible fees in private equity. They're quite large, 2% management fees, 20% carried interest. You basically cut that in half. The other investor fit we see is, investors that don't want to make 20 private equity commitments each year. They'd rather have one fund that's maybe a little more diversified. There's going to be a multi-sector approach, multi-stage and style approach. And that's how co-investment funds look. We basically partner with all these experts, the consumer focused expert that put us in Planet Fitness. And we have firms like KPS that are experts in industrial. We partner with these very smart people to build a portfolio that's uniquely diversified. That's really hard to replicate. Like, we don't pretend to be experts of any of those sectors, but we have very smart friends that help build us these portfolios for our clients.
Thank you.
one thing I'll add to that is that we do see more often now the larger investors, migrating toward maybe hiring. And Cook County did this, and Fernando was a big part of it, and he's to be congratulated because it's done extremely well. But using a private equity manager as a dedicated to overseeing the program, you can drive down your overall fees that way. Co-investments can be part of that program as well, but that's a way of kind of being able to really have a little bit more influence, I guess, over rather than just putting money into commingled fund of funds. It's a way of being able to have a little bit more control in terms of what your strategy is, what types of managers you want to look at.
Mhm. Yes, I have, okay, you had a question too?
Yeah.
Okay, so Mary,
Thank you.
Mary, Trustee Riley, and then Trustee Barajas, and then we're gonna have to wrap it up because we're approaching 12:30. We got one more presentation.
Question about the investable universe. Since there probably are fewer public companies, it appears that we're kind of forced to invest in private equity, even though the fees are higher. Do you find that true, Tom?
I mean, I don't think I'll let Bob, from my viewpoint, I don't think you're forced to invest. I think if you look at the net returns after fees,
Right.
that's kind of the key metric to look at. And as long as, and you do a good job here of tracking returns relative to a public market equivalent, as long as you're still getting a spread to what you could get in the public markets,
Right.
even after the fees, which I think Bob and I would agree are,
some of these managers can get pretty high. I think it's a worthwhile part of your portfolio. It's where you're going to really generate some alpha. But I don't know if Bob, you have a different opinion. I mean, there's different ways to think about private equity. I sometimes think about it as almost like micro cap investing. These are private companies. They just tend to be probably smaller than anything you're holding in your public equity.
I think forced was a strong term. I didn't mean it quite that way.
Right. But I mean, I certainly look at the valuations in the public market and they seem frighteningly high in some cases. So, one way to get at that is kind of stepping down a notch and investing in these smaller companies at typically lower valuations and hopefully growing them into larger companies that can be taken private and eventually sold at those very expensive public market
Right.
valuations.
Okay,
Thank you.
trustee Barajas.
Can you tell me a little more about, you talked about healthcare?
Yeah.
So where in healthcare do you see yourself being invested or co-invested?
Yeah, so we've had a little bit of investment in healthcare. So we've done a little bit in the veterinary space, which arguably is maybe a consumer service, but our pet is part of my family, so it's healthcare in my family. If we're going to do true healthcare, it's got to be a service where you're taking costs out of the system, and you're improving patient outcomes. So, an example would be, we have a business that provides like home health care a little bit with, respiratory patients, ALS patients typically, that, want to be in their home, but they need like a very high touch service for that, just given the complications that come with that disease. So we backed a company that provides the durable medical equipment to make that possible. And by being in the home, that reduces a lot of the cost of the healthcare, provision versus being in a hospital setting. And patient outcomes, are demonstrably better for folks that they, be at home at that stage of their disease. So that'd be one example. Trying to think back at some others, but that's one of the most recent ones we invested in. More of equipment rental. So it's usually provisioned, the hospital directs their buying towards this provider. Yeah.
Okay, that's gonna
Let's
conclude.
stop it.
Yes, thank you. We have to wrap it up. We are way over
Oh,
schedule.
sorry.
Thank you so
Thank you.
much. No, it's not your fault. I'm not saying that. But thank you so much. Very, very detailed presentation. Appreciate all of the detail and answers to the questions. So,
Appreciate that. And thank you for the opportunity and for your partnership. Really appreciate it.
all right,
Thank you.
you're quite.
And you're
All
not,
right.
Tom, you're not retiring soon. You're too young.
Well, you wouldn't know by the hairline, but yeah.
Well, hairline is deceptive. Just.
We actually walked into a pitch together and they asked us.
Oh. Okay, thank you, Fernando. We're at number 9, Coal Oil and Gas Holdings Report. Oh, I'm sorry. We do have that vote on 8. We did. Okay, so let's go here. I guess I'm in a hurry. Sounds like it. Yeah. No, I said, I guess I am now. Okay, so I will entertain a motion to approve the recommendation to invest $20 million with Mesero Co-Investment Fund 9. Can I have a motion for that?
So moved.
Second.
Okay, it is moved in second. So can we call? Yes. Roll call.
Trustee Barajas,
I'm going to abstain. I don't think I have enough information on them, to be honest with you.
trustee Blackwell,
Yes.
Yeah.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez.
No.
Trustee Benson
Yes.
and trustee Washington.
Yes.
Thank you. 7 ayes, 1 abstention, and 1 nay.
Be educated. You can't fucking abstain. This is the best.
Just final item, I'm just gonna spend about a minute on this. So just a coal, oil and gas report. We were doing this every 6 months, just reporting back to you how much we own. Nothing, it hasn't really changed that much. It's about 366 million. It's a little under 3% of the total fund. What is, I think, interesting is when we finally rebalanced international equity, because we were, a lot of the managers also have an ESG overlay. We'll see if that number goes down once we rebalance with those managers. And then also we are going to explore the domestic asset class structure later on this year to see if there are any possible opportunities towards our goal. But we'll be back to you on that. But the other thing also is we have started with proxy voting and we're onboarding Glass Lewis. And so I think we'll have a more robust reporting or report when we come to you with how they voted. So that's it. Thank you.
And now we're at unfinished business. Seeing none, I'm going to new business. Seeing none, I will take motion to adjourn.
So move.
You second? Yeah. Okay. Also, we have trustee Washington.
Trustee Barajas.
Yes.
Trustee Blackwell.
Yes.
Trustee Nelson.
Yes.
Trustee Ochoa.
Yes.
Trustee Price Ward.
Yes.
Trustee Riley.
Yes.
Trustee Rodriguez. Yes.
Yes.
Trustee Vincent.
Yes.
Trustee Washington.
Yes.
Thank you.
So quick announcement, trustees, because we run a bit over, we're going to have lunch now from 12:30 to 1. At 1 o'clock, you'll have your special board meeting. And we've got finance and audit to start at 2 o'clock. So 1 o'clock for special board, 2 o'clock for finance and audit.
Can we place that on our website?
It's already on there.
Perfect, thank you.
So then should we go ahead and do the special board meeting now? Or is it too late? Oh, all right.